Now, those are our current asset accounts then. Let's talk about the next category of asset. It's called property, plant, and equipment. And I want you to take your pencil and underneath where it says property, plant, and equipment, I want you to write fixed asset. Okay? Fixed asset. The reason why I have you do that is because I want you to understand that property, plant, and equipment and fixed assets are the same thing. There's no difference. It's just that when we talk about them, we usually call them fixed assets because it's easier to say. Property, plant, and equipment has a whole bunch of syllables in it. It's longer to write out and so forth. Usually on the reports we use, we call them property, plant, and equipment just because it's more descriptive. Okay? But fixed assets, and I'll probably refer to them in most cases as fixed assets. Now, there are 4 characteristics to fixed assets. First of all, they must be tangible. If you can't touch them, they are not fixed assets. Okay? You got to be able to touch them. They've got to be tangible. Now, you'll see that there are a lot of assets that we have that aren't tangible. Okay? But fixed assets, in order to be categorized there, they have to be touchable. So if you consider that and look around, everything in this room so far is a fixed asset, isn't it? Because you can see it. It's not mass. And so, well, we need to narrow it down a little bit. Second one is, I had to kind of cheat on this one, okay? And you'll see why later on. It's not inventory. What was inventory?
Products that we hope to resell.
Okay, we bought them with the intention of reselling them, okay? Fixed assets are items we bought with the intention to use, okay? For whatever reason, we intended to use them. Now, if we're a furniture dealer and we buy 5 desks, and 4 of them we put a price tag on, and the 5th one we take back to the owner's office to use, how are we going to handle that purchase of 5 desks?
4 of them are inventory.
4 of them will be inventory, and the last one will be fixed assets. Do you see that? Okay? So we distinguish between those two. Okay? Third characteristic, and this one's the one that really narrows it down, because with this second characteristic, I really didn't knock anything out of the picture here to speak of. Pretty much everything you see is still a fixed asset. But with this third characteristic, almost everything will go away. It must be material in value. In accounting, we refer to a concept called, or a set of principles called, generally accepted accounting principles. It's abbreviated as GAAP and sometimes referred to as GAAP. It's kind of the fundamental principles that we work on in the accounting process. And one of them is called materiality. Materiality says if it's not worth the effort, don't account for it. Okay? Now, fixed assets require special work. Stephen mentioned earlier that they go out and take a inventory that takes 5 days. Is that right, Stephen? Every year? And my guess is that was a fixed asset count, a physical inspection of fixed assets. Okay? And so it requires that at least once a year you go out and do that, which can take a long time in big companies. Small companies, it typically doesn't take long to do that because you might only have 10 items on there because the materiality level is only $300. See, if you consider $300, all of a sudden almost everything in this room is no longer a fixed asset. Okay, I mean the tables, the chairs, none of which individually cost $300, so you don't consider them as a fixed asset. Do you see that? So, the reason why we have that materiality level is so that we're not putting a lot of effort into inexpensive items. Now, that materiality level can change from company to company. But may I offer, it should never be less than $300. Never. No company should have a materiality level less than $300. 3/4 of the companies out there are probably going to be about between $300 and $500. And then you get the big corporations out there they might have 1,000, 2,000. You've got IBM, they have a materiality level of several $1,000s, okay? Because they're a big corporation. And so they don't consider it a fixed asset unless it might cost $3,000 or $4,000, depending upon where that materiality level is, okay? But most companies, $300, small companies, $300 is the right place to start. Okay, now with that in mind, let's go look at the fourth characteristic and final characteristic. The expected life must be greater than 1 year. If you don't anticipate that this item will have value beyond 1 year, it shouldn't be a fixed asset. Okay? Now, most things that cost over $300 aren't inventory and so forth probably are going to qualify as a fixed asset and going to be there for a year. But sometimes businesses do things differently. I'll give you an example. One of our students called up, had a landscaper as a client. She said, this one's kind of odd. They every spring buy brand new equipment from some local department store, and by fall it's trashed. Okay? See, most landscapers go out and buy commercial grade equipment that they're going to have for several years. For whatever reason, this company bought its stuff as residential grade equipment. Now, residential grade equipment, the stuff you buy out of a department store, isn't built to be run 8 hours a day, 5 days a week for 3 or 4 months or whatever the growing period is. Okay? And so by fall, it's unusable. Was that equipment to them a fixed asset? No, it wasn't. Now, on the other hand, if I were to buy the same thing and just mow the front of the office every week, would it be equipment fixed asset to me? Yeah, because it's probably going to last several years in my case. So all four characteristics have to be met in order to call it a fixed asset. And so to help you remember those four characteristics, and you'll see us do this several times throughout the course, we've got a little acronym. That's why I had to use it, it's trade, the inventory, and not, because I had to be able to use the I. It takes time for fixed assets. Fixed assets require not only that we take physical inspection, but also that we keep special tax records, that also that we keep special accounting records, that we depreciate them, and so forth. If it wasn't for that third characteristic of $300, this could be a fixed asset, a $1.50 eraser, okay? And we would have to assign it a number so that we could keep track of it separate from other $1.50 erasers. We would have to depreciate this over its life, this $1.50, which would have taken a lot of work. And we would have had to have, when we dispose of it, make a special entry into the books to record that we threw it away, okay? That's the reason for the $300. Now, I still run into companies from time to time that use a materiality factor of $100. Don't do it, okay? That's too low. Too many things now cost over $100 that it's just not worth keeping track of today. Let's say, for instance, that you buy a couch and a love seat for the reception area, and they're matching, okay? And you want matching furniture out there. And one is destroyed, okay? What are you probably going to do with the other? Get rid of it. They're a unit. Now, if each of them was $250, individually they wouldn't qualify, but as $500 does. And so in that case, they probably would be put as a fixed asset, okay, because they're used as a unit. Another good example is computers. Individual components within a computer, none of them cost more than $300. They're all less than $300. And so individually, it wouldn't be considered. But to be used as a computer, they have to be all hooked up together. So in that case, certainly they would be a fixed asset. Okay, let's look at the list of fixed assets then that we have. We have furniture and fixtures. What are we talking about there with furniture and fixtures?
Furniture and fixtures.
Give me an example. Yeah, okay. It's pretty descriptive. But will it include the lamps? Probably not, because they're probably less than $300. You can get real nice lamps that are $300. We've got one of the past students was a fixed asset accountant, because there are accountants that all they deal with are fixed assets, and for a big law firm downtown, and their bookends, they had bookends that cost $5,000. I mean, so you can say that anything, could maybe pass here, but most bookends aren't going to run over $300. Okay, machinery and equipment, that's pretty self-explanatory. Leasehold improvements. If you lease a building and you make improvements to that, now improvements means attaching it to the building, okay? I mean, certainly bringing in desks and chairs and things like that are improvements. It's going to make it more useful to you, but it's not a leasehold improvement until it's attached to the structure. So if you were to rent an office space and then have a contractor come in and build a wall and maybe a closet space and things like that, and you, the tenant, pay for those improvements, it's your asset, but it's called leasehold improvements because it's attached. Now, the reason why we recognize this differently is, one, when we talk about depreciation, you'll see we treat leasehold improvements differently under depreciation laws. And secondly, because at the end of the lease, anything that's attached to the building, unless you've made arrangements with the landlord beforehand, anything that's attached goes with the building. You can't take it with you, okay? So if you have this beautiful reception area and you go out and you buy this $5,000 chandelier to go in there, you, the tenant, pay for it and you attach it. Whose chandelier is that at the end of the lease? The landlord's. Unless you've gotten approval from the landlord beforehand. So it's a good idea to get them to sign off and say, yeah, I don't mind, you take it with you. Lori?
Why would it be an asset if it's not yours?
Well, because you're getting, good question. Lori asked, why would it be an asset? Because you're getting the benefit of it. Remember, I mentioned assets are things that you own or are getting the benefit of. And that's something that you actually own the benefit of that wall for the term of that lease. Okay? Now, if you don't have a lease, then yeah, you're right. The landlord could at any time come in and take over, couldn't they? And get that. But that you're probably not going to put a whole lot of money into a rented space that you don't have some commitment for. Okay? So, leasehold improvements. Main difference is what? Attachment. So what do a lot of businesses do today when they go in and lease a building? They use the partition, the modular systems. Have you noticed that? Are those attached? Why do they do that? They get to take them with them. So they oftentimes today in office buildings, they just are big rooms, and then they bring in their own partitions. And of course, management says, oh, this is going to improve the atmosphere in the office space. And so we've made this big investment for your benefit, But really what they're thinking about is, one, there's tax advantages to doing that, okay? And secondly, they can take them with them at the end of that lease. Do you follow that? Okay, now we also have buildings or vehicles as a company car, buildings and land. We have to split, when we buy a building, we have to split the cost between building and land because we pay one price for both, don't we? We don't say, I'll pay you this much for land and this much for the building. We say, I'll pay you one price for both of them. But as we'll discuss tomorrow, land is not depreciable. Buildings are. So we might pay $500,000 for the building, and we might apply $100,000 to the land and $400,000 to the building. And why do we do that? Because the $400,000 building is depreciable. That land will always stay on the books at $100,000. Okay? So you have to make us, but when we talk about depreciation, we'll show you how to do that. It's a very simple calculation to be able to distinguish between those two.